Is everything awesome for technology in corporate America?
Well, no, not everything is awesome in the sense of technology is not immune at all from the uncertainty generated by the tariffs and the questions as to what that will mean both to the economy, but then also to actual policy and therefore expectations for corporate profits. So that uncertainty lingers, but I think everything is certainly wonderful so far in terms of operating results that have been reported. We are holders of both Texas Instruments, which is up a lot today, and IBM, which is down. But IBM has been an absolutely unbelievable performer. And really, the AI side was good news. The stock would be down more today if it were not for the AI boost. It's the software growth was only 9% quarter over quarter when they had done 11% the quarter before. So some deceleration in what's been a very successful growth in that hybrid cloud, the former Red Hat business that they acquired. IBM has executed very well, and we're big believers long term in what they're doing, that whole story. There's a lot of good news in the technology sector, but you just simply can't overpay for the good news.
David, what's so interesting is, yes, maybe there's some profit taking given the run up in IBM and its resiliency amid the tariff uncertainty. But Arvind Krishna said, look, demand signals are still unchanged. Is that likely to remain the case? How much are we already basically paying for inventory pulled forward by Texas Instruments and a resiliency to consultancy that might not withstand what could be a real slowdown in the economy?
Well, there is a very big difference in the answer to that from Texas Instruments to IBM to other companies that are part of this AI CapEx story, like let's say in Nvidia. Nobody's going to be immune if there's a system-wide demand slowdown and a recession that lasts more than a few minutes. But there's uncertainty as to what exactly will happen. I expect that there will be a slowdown. And again, we don't own any company for the sake of one quarter of results. So I think you could very well see a slowdown that impacts fundamentals short term. The question is who has the resilience, who has the balance sheet, who has the business model to most execute through that. I have no doubt Texas Instruments and IBM belong at the top of those lists. They're not dependent on a somewhat unsustainable AI CapEx cycle, let alone are they relying on a PE ratio that has been totally unsustainable to hold the stock price up.
Okay, who is at the top of that list for you in the weeks to come?
Well, and Nvidia, I should go easy on them because they've obviously had a tough time through this. But I think when Nvidia was $150, trading 80 times forward earnings, now down here into the lower hundreds, it's certainly cheaper. But it's very much tethered to a big story around AI CapEx and suffers from law of large numbers. Just when you get to that 3 trillion market cap, it's very difficult for people to realize that a 20% gain, which is not really what their shareholders want. They want something more than that. But the math of that requires it to add like almost $1 trillion of market capitalization. So it's just very difficult to make money out of those valuations. So Nvidia is a good example there. Look, we're dividend growth investors, and so Nvidia is not a name that we'd be looking at anyways. I think IBM, if you look at the dividend on cost for people that were buying IBM a number of years ago, we entered the position about 7 years ago. It's been unbelievable, and everyone focuses on how well the stock price is done, and that's great. It makes us look good. But for me, it's a cash-on-cash story. Their dividend growth has been remarkable.
David, what about buybacks as well? Sorry to jump in there, but many are expecting companies are going to make the most of their capital haul right now.
Well, I think that stock buybacks to us are at best supplemental. Most technology companies don't use it as real capital return. They use it as executive compensation. To the degree you're at least buying back the shares that you issued because of stock options and executive comp, I think that that's a very good thing. As a capital return strategy, we prefer it be second tier, not first, and IBM's a good example.